Hey everyone, welcome back to Realized Gains. Today we're talking about a major shift in the bond markets that's making waves across the globe. From US all the way to China, US Treasury yields are climbing above 5%, while China on the other hand, 10-year government bond yields have dropped below 1.6% for the first time ever. This might sound just like another market stat, but trust me, there are huge implications for global finance, the US economy, and even your investments, because the US and China are one of the two largest trading partners in the world. So let's break this down. Why are these yields diverging, and what does it mean for you? First things first, we gotta ask ourselves, what are bond yields and why do they matter? So, with the basics, right? Bond yields are essentially the return investors get when they buy government bonds. To put that into perspective, during the height of the COVID-19 pandemic in March 2020, the US 10-year Treasury yield fell to 0.33%. That was a historic low driven by fear and uncertainty. China is encroaching towards that point as well, but we're not in a pandemic. So what does this mean for China? It suggests a few things. Number one, weaker economic growth. Investors aren't expecting strong growth from China anytime soon. Number two, central bank policies. The PBOC, People's Bank of China, is likely keeping monetary policy extremely loose, pumping liquidity into the system to stabilize the economy. But there's a bigger story here. It's not just about China. This could have a domino effect on global markets, especially for the US investors. So, why should US investors care? You might be wondering, what does this matter to me? I'm not in China. I'm also not in the US. I could be anywhere in the world. I don't even invest in Chinese bonds. Well, here are three reasons why this matters to you. Number one, there will be an impact on global growth. China is a key driver of global demand. If its economy slows, it would hurt industries worldwide, especially those reliant on Chinese consumption like tech and luxury goods. For example, companies like Apple and Tesla depend heavily on Chinese customers. A slowdown there could mean lower earnings for these US giants. Number two, commodities markets take a hit. China is one of the largest importers of commodities like oil, copper, iron ore. If its economy slows, demand for these materials could drop, driving prices down. That's bad news for the US energy and mining companies. Number three, investors' flight to safety. When investors see economic troubles in major markets like China, they tend to flock to safer assets like US Treasuries. This could push Treasury yields lower, indirectly benefiting US stocks by making equities look more attractive relative to bonds. There's also one very key important thing here, which I must stress. There is actually a geopolitical angle at play here. China is actually smart by lowering its bond yield this much. Because China isn't just issuing bonds in its own currency, it's actually issuing US dollar denominated bonds. And it's a very, very bold move, because it serves multiple purposes. First off, by diversifying its reserves. By issuing USD bonds, China reduces its reliance on US Treasuries, which it has traditionally held in large amounts, being the largest holder of US debt, right in front of Japan. It also challenges the dollar's dominance. By offering alternatives to US debt, China is strategically positioning itself as a safer option. One example is that China issued US dollar bonds in Saudi Arabia. Why Saudi Arabia? Because it's a major oil exporter and part of the OPEC region and a key player in the petrodollar system. By issuing bonds there, China is building stronger economic and geopolitical ties while challenging US dominance in the Middle East. Oil to be traded in yen, and they're also pushing for the BRICS currency to be more adopted in the global monetary system. Why might this be appealing to foreign investors? China's USD bonds have been oversubscribed by 20 times in some cases. This shows strong demand from global investors who see these bonds as a safer or more strategic alternative to US Treasuries. And here's where it gets really fascinating. The fact that Chinese USD bonds have lower yields than US Treasuries signal a shift in global investor sentiments. Why would someone accept a lower return on Chinese bonds than on risk-free US Treasury? The answer lies in perception. Why take on the US debt when it's mounting up to 35 trillion now and they might not be able to pay back? Or take a much lower return on Chinese bonds when you know that they have much better ability to pay back given the trade surplus that China has. So it also goes to show that a lot of people are losing trust in the US abilities to pay its debt. They can't constantly keep increasing their debt ceiling and expect the rest of the global market to play along with that, okay? So this is a very worrying fact for a lot of the US Fed. So let's zoom out and look at the broader implications. The US dollar has been the cornerstone of global finance for decades. It actually has the hegemony of the global money supply, it is the global reserve currency, and it's used in 88% of international transactions, being the world's primary reserve currency. But moves like China are chipping away at its dominance by issuing these bonds, strengthening ties with countries that major exporters of oil like Saudi. China is undermining the petrodollar system. And this is the very system that gives the dollar its dominance, because in the fiat currency system, the only thing that gives it credibility is in its ability to purchase goods and services. And once you lose that, you lose the hegemony of the dollar. So what does this mean for us investors? If you're investing in China, pay attention to structural reforms and confidence indicators rather than just stimulus announcements. For US investors, understand that the rally might be narrow and driven by specific sectors. So you look at the whole equities market rally, it is driven by tech mostly, and you might want to consider diversifying. Of course, both equities market, bond markets, and China and US have risks and opportunities, so understanding how these dynamics play out can help you make smarter investment decisions. As always, remember to like, share, and subscribe, and I'll see you guys next time. Bye.